Hello, I'm Scott Murdoch, Senior Analyst with the Morgans Research Team. As we sit here today, markets around the globe are being sold off on the prospect that Greece may default on its sovereign debt profile. A perfect opportunity to interview our Chief Economist and Senior Strategist Michael Knox for an update on the situation. Michael, can you just give us an overview of what's actually happening in Greece as we sit here today?
We are at the end of a period of negotiation of many weeks, a month in fact, between the government of Greece and the Eurogroup. The Eurogroup is the Council of Finance Ministers of the Euro area. And the Eurogroup has been putting forward proposals that are in turn based on the analysis provided by the European Central Bank and the European Commission and the International Monetary Fund. Now, over many weeks, it was thought that agreement had been reached on a number of issues that had been put forward by the Greek government. These included things such as changes to the value-added tax, in which the Greek government wanted value-added tax reduced on things like energy, and an even lower value-added tax on things like pharmaceuticals. They also wanted to increase the company tax rate. They also wanted to reduce corporate taxation concessions for farmers and major shipping companies. And the Eurogroup, in its proposals over weeks, gradually accepted those proposals of the Greek government. But the problem is that the major central issue that is the core section of disagreement between the Greek government and the Eurogroup was entirely ignored, or mostly ignored, by the Eurogroup, and that is how big a budget surplus that Greece has to run in order to repay its debts to the Euro area. When the negotiations started, Greece was required by the Eurogroup to reach a budget surplus of 4.5% of GDP. Now, this budget surplus, which was targeted to be achieved in 2018, has only been achieved, a budget surplus of this size has only achieved once previously in the history of the Euro area, and that was by Finland during the period of the Nokia boom. Now, Finland is running a budget deficit of 2.5% of GDP and couldn't achieve a budget surplus like this. If we look at modern comparisons, things that are happening in 2015, we find that Germany, which is the largest country in the Euro area, is running a budget surplus this year of 1.4% of GDP. And that's the biggest budget surplus it's going to run for the rest of the decade. So as a part of this negotiation, the Eurogroup reduced the budget target from 4.5% of GDP to 3.5% of GDP. But we note, and of course it's entirely obvious to the Greek government, that this budget surplus is 2.5 times that which is currently being run by Germany. So the Eurogroup is expecting that Greece, which is one of the smallest economies in Europe and with one of the weakest economies, is going to run a budget surplus which is 2.5 times that of the strongest economy in Europe. Now, most economists who work in the area suggest that this Eurogroup proposal is unrealistic, and many suggest that the idea that Greece can run a budget surplus of 3.5% of GDP, this is a primary budget surplus of this level, would be unsustainable. And talks have broken down on this, precisely this issue. So we are now at a situation where from Saturday, since talks have broken down, that as banks banks have been closed in Greece, and only small amounts are able to be withdrawn by Greek citizens, 60 euros a day for private citizens, larger amounts for corporates, but only with the prior approval of the Greek government, and this is what is called capital controls, and these capital controls are in place ahead of a plebiscite as to whether or not the voting population will accept the conditions of the Eurogroup put forward in their last offer. We have another roadblock between now and next week, and this vote, however, and that is that at 2:30 or 2 p.m. On Wednesday, Australian Eastern Standard Time, which is midnight in Washington DC, the headquarters of the International Monetary Fund, that Greece will at that moment default on its loans, on a loan to the International Monetary Fund by failing to make a due payment. Now, we do not know if that will aggravate the position of the Greek banks and affect the support of the European Central Bank to support the Greek banks and allow them to stay in operation. So international stock markets, with all this information, have taken fright and sold off, which in the circumstance seems to be a fairly reasonable response.
Michael, as you said, markets have sold off overnight on the back of this news, but there are going to be some implications to a scenario like this. Can you give us some thoughts on the market implications from the scenario?
Well, the major problem is that we started this crisis with a position that the S&P 500 was moderately overvalued. We had relatively poor earnings seasons in the beginning of this year, with earnings showing no growth. As a matter of fact, a slight decline in earnings per share of companies in the S&P 500 from the position last year. And that was because of the weak earnings of oil companies, pretty similar to the situation in Australia. And that means that fair value of the S&P 500 at the moment we make as 1,815 points. It started from a position last week of being over 2,100 points. It's now fallen back to about 2,050 points at the time when we're talking, and could continue to fall over coming weeks towards fair value. So it's really in a circumstance where the events in Greece are a detonator to a situation where a moderately overvalued US equities market was already likely to have a bull market correction of some time in this quarter, and now that bull market correction has begun and may continue for some weeks.
Okay, Michael, a few more weeks of market volatility potentially, but a resolution, when and how, I guess, if you have a crystal ball?
Well, we don't know, of course, how the Greek situation will be resolved. There is a vote, as we said, next weekend, and the result of that vote is the majority of Greek voters could vote to accept the terms and conditions put forward by the Eurogroup. And if that is the case, the International Monetary Fund says that it will work towards making that agreement live again and opening the banks again in Greece, and Greece remaining in the euro area. That is one plausible solution. Another plausible solution is that the voters in Greece vote against accepting the conditions, and then the banks will stay closed. There will be a negotiation between the Greek government and the Eurogroup about reducing the level of debt, restructuring Greek debt. The strategic objective of the Greek government is to attempt to reduce their sovereign debt from 180% of GDP which it currently is, to around about 90% of GDP, which they think is manageable, and they could sustain with a budget surplus of about 1.5% of GDP. Many international commentators think that that would be a long-term solution. The third possibility would be that there is no agreement with the euro area, and that means that the period of instability is prolonged and might continue more than just a few weeks. In that circumstance, Greece would have to set up its own currency. It would then default on 100% of all of its debts to the Euro group and to the International Monetary Fund. That would generate the largest single default to the International Monetary Fund, which has happened in the history of the International Monetary Fund since 1945. And we would certainly believe that that would generate greater volatility. But out of that would come a country with its own currency. The economy of Greece is significantly larger than that of New Zealand, for example. New Zealand successfully runs its own currency, therefore Greece could too, but it would take many months for the Greek currency to stabilise at a new lower level, which would make the Greek economy more competitive. My guess is that we could be well towards the end of the end of this quarter under the final scenario before we saw markets calm down sufficiently. So it depends very much on what happens and the form of resolution to when this turmoil ends.
Thank you, Michael. Thanks for your time today.
Thank you.